You know, we haven't had a correction in the stock market, Bill, since 2011. We had a couple of attempts that didn't quite make the full 10% pullback. Are you concerned? I mean, you think that the average investor should be concerned about the stock market here?
Well, I think they should. I think stocks are fully priced, and let's analyze it from why they're fully priced. You know, the Fed has been buying bonds and mortgages for the past several years at a $4 trillion total pace, and so that's an injection of money into the financial marketplace that has led to higher stock prices. That will stop at the end of October, and so perhaps the markets are beginning to anticipate that. In addition, and it's fair to attribute the rise in the stock market to buyback programs from corporations. We don't think those will stop. They have a lot of cash. They continue to like their stock versus investments in the real economy. But you know, PEs at 15 to 16 times with the absence of the Fed in terms of their buybacks. I think we're tapering off here, to use a term more applicable to the bond market.
So, you know, you talk about Main Street and Wall Street. I will say that Main Street, the savers have been getting killed, Bill. You know this. I just checked these CD rates. The average rate on a one-year CD is 0.24%. That's embarrassing. 0.79% on a 5-year. Are we heading into an era now where savers are going to be rewarded again? Is that going to be next year?
I don't think so, and no one knows. But we can go back in history and look at periods of financial repression that you just described, in which savers are repressed in terms of what they're allowed to earn on their savings. And typically we had a period after World War II and the Depression, in which for 50 years basically savers were repressed in terms of their yield. So these things can continue, and they continue because the financial markets and the economy is basically highly levered, and they continue because growth is facing some structural headwinds in terms of tailwinds. And so savings rates for savers, unfortunately, will be low going forward. And that's the same thing as saying that bond yields will be low going forward. It's not a fair break relative to the last 20 or 30 years, but it is what we think the reality.